Good afternoon. You're all welcome to the Deputy. And the Deputy Governor will give the statement, and then we'll have a Q&A session after that. So, Deputy Governor, you're welcome to give the statement.
Thank you very much, Director of Communication, and a very good afternoon to all of you viewers and listeners. Welcome to the reading of the Monetary Policy Statement for the month of April 2023. At its meeting on 6th of April 2023, the Monetary Policy Committee, MPC, maintained the central bank rate CBR at 10%. The economy has broadly evolved in line with our expectations at the February 2023 MPC meeting. The March 2023 data from the Uganda Bureau of Statistics indicated that annual headline and core inflation dropped to 9% and 7.6% in March 2023 from 9.2% and 7.8% in February 2023, respectively. The annual electricity, fuel, and utilities, as well as food crops inflation, also dropped to 4.4% and 26.7% in March 2023 from 5.2% and 27.4% in February 2023, respectively. The decline in inflation is on account of a reduction in international commodity prices, improved global supply chains, and the relative exchange rate stability due to tight monetary and fiscal policies. Although the shilling has weakened marginally against the US dollar since the beginning of the year, in part due to seasonal factors, it has strengthened when compared to currencies of Uganda's major trading partners. In the MPC's current assessment, absent new shocks, inflation will continue decelerating and converge to the 5% target by the end of 2023. The factors favoring the continued decline of inflation are lower energy prices, improved global supply chains, lower food crop prices due to favorable weather, the existing spare capacity in the economy, and the exchange rate stability owing to the tight monetary and fiscal policies. Fiscal restraint has dampened demand, thereby limiting inflationary pressures, while at the same time putting the economy on a sounder long-term footing through reducing public debt and investing in infrastructure. The inflation outlook is, of course, subject to several risks. The upside risks include: 1, the persistence of high domestic food prices despite the good rains in the second half of 2022. 2, the tighter global financial conditions, which could exert pressure on the shilling exchange rate. And 3, the higher oil prices following the production cuts by the Organization of the Petroleum Exporting Countries and Russia. The downside risks include: 1, a considerable slowdown of the world economy, and 2, a reduction of the geopolitical risks and a better functioning of the supply chains, and 3, a stronger shilling if global financial volatility dissipates and the external financing gaps decline. The balance of risks to the inflation outlook remains biased to the upside. Economic growth remains on a recovery path, averaging 6.8% in the first 2 quarters of the financial year 2022/23, and this was supported by a stronger recovery in services and agricultural output. However, the quarterly economic growth for quarter 2 of financial year 22/23 dropped to 4.4% from the 9.2 recorded in the first quarter of financial year 2022/23 due to a decline in industrial output and a moderation in the services output growth. Moreover, growth in economic activity measured by high-frequency indicators point to a moderation in the recent months. The Composite Index of Economic Activity, CIEA, grew by 0.9% in the 3 months to February 2023, which is lower than the 1.2% growth in the quarter ended November 2022. The moderation in growth partly reflects the tight monetary and fiscal policies as the increase in domestic interest rates and tight credit standards by banks affected the growth in the private sector credit. The MPC projects economic growth in the 5.5 to 6% range for the financial year 2022/2023, remaining below its long-term trend until financial year 2025/26, partly because of the tight domestic and external financial conditions. Moreover, growing external financing needs are expected to put pressure on the shilling. With lower export-to-import prices and slower growth in export volumes, the current account balance is forecast to deteriorate to a deficit of 7.4% of GDP for the next 3 years, keeping some drag on economic activity. There are also additional downside risks to the economic growth, and this includes the following. 1, lower than expected global growth, affecting the demand for exports. 2, a combination of uncertainty, higher interest rates, cost of living pressures, and the government's fiscal consolidation, though necessary, could weigh heavily on household consumption and private sector investment decisions. Thirdly, the lower commodity prices affecting our primary commodity exports. Fourthly, unfavorable weather conditions which could affect agricultural production. Fifthly, the resurgence in the supply chain distortions due to geopolitical tensions. And last but not least, weaker than expected global economic growth outturns or much tighter and more volatile global financial conditions. The MPC assesses that the near-term risks to the inflation outlook remain elevated, with considerable uncertainty surrounding the economic outlook. The MPC, therefore, maintained the CBR at 10% to contain inflationary pressures sustainably. The bands on the CBR will remain at plus/minus 2 percentage points. The margin on the CBR for the rediscount and the bank rates remains at 3 and 4 percentage points. Consequently, the rediscount and the bank rates will be 13 and 14% respectively. The MPC assesses that the current policy stance remains appropriate to contain domestic demand pressures while supporting economic growth. Looking ahead, the MPC's policy decisions will be guided by the inflation outlook in light of the incoming economic data. The MPC also noted the heightened volatility in the global financial markets due to the challenges in the USA and the Swiss banking systems on account of the valuation losses, which were partly responsible for it, accounted for by increasing interest rates. However, the Ugandan banking system remains well capitalized, highly liquid, and well placed to absorb emerging interest rate shocks and to continue providing credit to the economy. That ends the reading of the monetary policy statement for the month of April 2023. Thank you for your very kind attention.
Thank you, DG. Now we go to the Q&A session, and we are on both Teams and YouTube. On Teams, you can raise your hand, and if you raise your hand, then we request you to unmute, and you ask your question. And then on YouTube, we are accessing your questions through the chat. Okay. The first question I have is from the chat, and it is Nabat of Uganda Radio Network, and he's asking Deputy Governor to talk about the global developments about the dollar and the yen. As more countries adopt training in the yen, what does it mean from the standpoint of Bank of Uganda? Will Uganda and Africa feel the effects either sooner or later? Should we be concerned? Yuan. Yeah.
I think first of all, before I answer the question, I don't know whether the colleagues have been introduced here.
Yeah, okay. Sorry about that, DG. Before we start the Q&A, I'd like to introduce the other members. And we have Executive Director Supervision, Dr. Twine Manzi Tumubwene, and we also have Executive Director Research, Dr. Adam Mugume. I have my colleague, Deputy Director Communications, Dr. Bazinzi Natamba, and my other colleague, Assistant Director Communications, Mr. Andrew Erana. And I also have Sylvia Juko, who's in communications, and Carlos, who is also in communications. Thank you, DG. We can start the Q&A.
All right. Thank you very much for the question. I will just give a broad overlight, to it, but I'll ask Adam, who is the Executive Director of Research, to weigh in after I've said something. I think the most important thing that we need to understand is that the UN, the yuan is becoming an international currency, and already it is part of the basket of the currencies that constitute the special drawing rights. So we would expect going forward increased use of the yuan as an international currency. And of course, each country will determine how they are going to hold their assets in yuan, depending on the volume of trade, the exposure in terms of debt, and other factors that are going to be considered. So I think each country there will be some specific country issues that will determine to what extent the yuan will be held, including the trade relationship that we have with that, with China. So in my view, it is not a problem having a yuan or holding yuan, depending on the volume of trade, depending on your data exposure, since it's also part of the basket of the currencies making up the special drawing rights. But I don't know, Adam, whether you want to add something to that.
Thank you, DG. I think the mic is not working. Nothing really. What I can add on is one line, knowing that if you look at USA economy in terms of trade, it controls about 24% of the global trade, world trade. Chinese is around 15%, and other countries come on board, including Europe, Japan, and the UK. So that really what constitutes the basket of currencies that we, a country looks at. So if our trade is increasing, going into China, then the invoicing also might coming in through China. Obviously, then yuan becomes a relevant currency. So overall, therefore, there shouldn't be any worry of yuan being a reserve currency. Since China's trade in the global economy controls about 15%, so that's looks a healthy development in terms of really having other currencies as part of the reserve asset. But again, looking at the way the invoices are done, even if sometimes you trade with China, you still, the invoicing could be still in dollars. I think it is still very far away to say that the dollar will weaken in terms of determining the global payment system. So the dollar remains vital, although the yuan is coming in gradually to start challenging the dollar. Thank you, DG.
On the we have on Teams, we have Samuel. Samuel, if you can hear me.
If you can hear me.
I can hear you. I can hear you. Can I go ahead? All right. Someone said Tumba is my name. I have three questions. First of all, question one part is the world heading for recession. We just want to be sure of that. And either way, things don't look okay because at home, as the governor said there, we are tightening, fiscally speaking, consolidation. Our global ratings slid a little bit to negative. What does the set of that scenario portend for the real economy of Uganda? Our slide in ratings, maybe a possible global recession, and our fiscal tightening here. Number two, agreeably, inflation seems to be curtailed from escalation. However, the reality on the ground leaves Sorry, somebody was trying to call me. Let me ask that again. Inflation seems to be curtailed, but cost of living remains very high. Incomes are not improving for those who are working or for Ugandans. Are the statistical averages we are relying on really reflecting the reality in the Ugandan household? Like inflation is looking not bad, going down, and other variables that the governor quoted, are they reflecting the reality in the Ugandan household? And finally, with a combination of a weakening shilling, global oil price outlook shows a possible rise, as we have had, because of OPEC, which is an artificial factor for me, because OPEC decides they want more money, so they rise. So how is this economy prepared for the ugly parts of such a scenario? The shilling is going to be challenged. Global oil prices look to be going up. How are we ready to face that as an economy? What are your thoughts? Thank you.
Thank you, Samuel. DG?
Okay, Samuel, thank you very much for your questions. You've asked three questions, one to do with the recession, one to do with inflation and cost of living, and then the other to do with a weakening shilling and a possible rise in the oil prices. So I think I will request Adam to answer the first one in terms of the recession and where we're going. And then let me look at the second and the third. On inflation and then the cost of living, yes, I think we kind of like hit the peak in terms of inflation in the quarter ending December 2022. And we are beginning to see that inflation is now on the downward trend. And while it's on the downward trend, it remains quite high compared to where we want to be. Our medium-term objective is to have inflation at 5%, and as at the end of March, it was at headline was about 9%, and of course the core was 7.6. That is well above where we want to be. But the most important thing is that it is beginning to come down. Now, how does that impact the cost of living? I think it impacts the cost of living through the erosion in the purchasing power of the people's incomes. The higher the inflation, it means that the lower is the purchasing power of the income that you have. So as a central bank, we are very much interested in preserving that purchasing power of people's income, and that's by bringing down inflation. So I agree with you that the conditions are still unfavorable because of the elevated inflation compared to where we want to be, but the actions we're taking now are meant to bring inflation down to 5% so that we restore the purchasing power of the people's income. Now, Samuel, I did mention that there were downside risks in as far as inflation is concerned, and some of the downside risks were the weakening of the shilling. Like I did mention, that if the global conditions become tighter than they're right now, then we could end up with a weaker shilling. And also, if the cuts in the production of oil by OPEC countries take effect, then we could have higher oil prices. So that will, of course, translate into higher domestic prices, which means that inflation might actually turn out to be higher than we are currently projecting. So, but the good news, of course, is that there's a limit to which you can also raise the oil prices amidst a situation where the demand is not growing as fast. In the past, we've seen oil prices go up and come down again. So I think even as you increase the price, you need to look at the demand side for it. Will the reopening of the economy of China, for example, sustain the demand for oil and the prices that the OPEC cuts have introduced? So these are the things that we need to wait and see, and that's why we are citing upside risk to inflation. So if this materializes, inflation will be higher than we think, and as a central bank, we will be forced to tighten monetary policy further in order to preserve the purchasing power of people's income. Again, the question that you asked previously. So let me ask Adam to address the one of the recession.
I think you can hear me. In terms of the recession, I think somewhere combine two questions, one global and then try to bring in the fiscal side, consolidation side. The numbers we have currently don't point to the global recession. Yes, there is a growth slowdown globally, but not a recession. A country that had been projected to be in recession was, I think, UK, but again, the numbers that came out, I think, towards the end of the year indicated that it never went into a recession. So globally, we don't see a recession, but there is economic growth slowdown. So that obviously translated to part into our domestic economy in the sense that they are spillover from the slowdown into domestic economy. Partly, what also the Deputy Governor said is the exchange rate, challenges because of the global financial volatility, etc. But also other issues, other things. Once the global economy slows down, things like foreign direct investment and travel receipts obviously also come down and they spill over into domestic economy. But so far, that said, we don't see that being a strong impact on the Ugandan economy because continuously we see a growth recovery. We know, as the Deputy Governor said, growth will remain below the potential of 6.5 to 7, in the range of 6, between 5.5 and 6, but again, that is not a recession. Even with the, and those numbers also put into the projection, the fiscal consolidation. Fiscal consolidation, I think somewhere knows it is warranted in the sense that we have to contain also our overall debt dynamics, while also supporting a growth outlook in the medium to long term. So overall, what I can say is that, yes, globally there is slowdown, but not a recession. And domestically, yes, growth will remain on a recovery path, growing in the between 5.5 to 6, but again, below the potential, but again, not a recession. Thank you.
Okay, thank you, EDR. And then we have a question from the chat. Ali Twaha says, thanks for the presentation. And then recently, Finch revised our credit rating from stable to negative. Their projection that our reserves might dip to as low as 2.4 months of import cover, despite the support we plan to receive from the IMF. Kindly comment on the impact of this report.
Thank you, Ali, for that question. I know that this has been making rounds in the media in the recent past. But let me start by saying, I think one part that Ali has forgotten to mention is that Fitch also affirmed the overall country rating at a B+, at a B+. So the only thing that changed was the outlook. The outlook changed from stable to negative. And it changed from stable to negative largely because of the challenges in accessing concessional financing for our budget, and because of the challenges in accessing concessional financing for the budget, we are borrowing money now at commercial rates, at non-concessional terms. And those non-concessional terms, of course, increase the debt burden. And once you increase the debt burden, then there, you pose some questions regarding the sustainability of debt going forward. And not only that, the Fitch also pointed that because of the reduction in our reserves, that was pointing towards challenges going forward. But I think the most important thing is what is the government doing about the situation? So government is undertaking serious fiscal consolidation. Once you take fiscal consolidation, it means that your budget deficit is expected to come down, and therefore your borrowing needs should be coming down. And once your borrowing needs come down, therefore you are mitigating the impact of the heavy debt burden going forward. Now, in terms of reserves, yes, our reserves had dipped for a number of reasons. The first one was that we used to build up our reserves by purchasing money from the foreign exchange market, and most of this money, most of the the dollars that were coming in were on account of the portfolio players who were investing in our government securities. But since the advanced economy central bank began raising their policy rates to fight inflationary developments, we saw a reversal of these inflows and also exit of some of the players from our market. So it means that our capacity to build reserves was constrained. We didn't have the chance to build reserves as much as possible as we would have wanted, because the amount of money in the foreign exchange market was not sufficient to enable us to build reserves. So that's why one reason why the reserves have come down. Of course, there are other reasons that are linked to the high debt service. Our debt service is projected at around $900 million in 22-23. Now, going forward, we estimate it to be close to $900 to $950 million per year over the medium term. So that's partly reflects why the reserves have come down. But we are working towards rebuilding reserves. And indeed, our reserve coverage has increased from the low of about 3.5 now to about 3.7, and we hope to close the year at about 3.8 if all the inflows were anticipating come. So we are working towards rebuilding that position that has led to a change in the outlook from stable to negative. So Ali, yes, the outlook has changed, but we're working towards bringing it back to stable. But most importantly, Fitch did affirm a B+ for Uganda as the overall country rating, and that is the most important thing, because the outlook is only a subset of the overall country rating. Thank you.
Thank you, DG. In-house, we have Dennis from UBC.
Okay, thank you. Dennis Igor is my name from UBC TV. I do have two questions. And earlier on during your presentation, you talked about the geopolitical tensions and, of course, the impact that it has had on our economy, generally the regional economy. We now have our neighbor, whom, of course, you can see the tensions also coming up. Is there any, do you foresee any impact in as far as the economy is concerned in the shorter or longer term? Then, if we have been on the social media, also the talk has been which country has dollars. Looks like there are countries in the region that have a dollar shortage. And as far as dollars are concerned, which is, like you've said, is a vital currency, how are we standing as Uganda is concerned? Thank you.
Okay, thank you. Is it Dennis? Yeah, thank you, Dennis. On your first question, certainly there were some concerns that if what we are observing in the neighboring countries were to continue, our capacity to bring in goods from the port into Uganda could have been affected, and possibly some shortages would have been realized, because we have seen it in the past, right? So there were those concerns. But I also want us to be optimistic that at the beginning of this week, I think there's some progress towards normalization of issues. So let's build on that. Let's see how it happens. So, but certainly it would have been a source of concern if that were to continue. It would have affected our imports, even our exports. And by the time you think of diverting routes, it will take some time. But hopefully the developments of this week are sustained going forward, and what your concerns are do not come to materialize. Now, I don't know when you talk about countries having dollars, what you are really meaning, but I...
Okay, we are so much on the social media. Of course, there was a comparison. So I'll give an example. I don't want to mention a country, but there are countries where there's a claim that they are actually facing a lot of high inflation because of their impact of because of the lack of dollars in the market. So, of course, runaway inflation and stuff like that. So as far as dollars are concerned, how safe are we? Do we have the dollars?
Dennis, have you walked into any forex bureau with your shillings and failed to get dollars?
No, I've got.
So you are constant in the shillings, but the dollars are there. Yeah.
Okay, thank you, Deputy Governor. Before we go to Victor of NTV, there's a follow-up question from Ali Twaha of New Vision, and the follow-up is regarding our fiscal consolidation plan. Our fiscal operations for February show that the country's domestic fiscal balance more than doubled, largely on interest payment. Is the fiscal side letting down the monetary side?
Okay. Let me ask you to answer, then I will just wrap it up.
Twaha, fiscal consolidation remains on track. If you look at the fiscal operations for the first 8 months of 2023, you see that fiscal deficit is much lower than what had been projected before. I think the difference between what had been projected and what came out is around 1 point something, or 1.5 trillion or so. Now, and that is in spite of the increase in debt servicing. You are absolutely right, yes, there was high interest payment because yields rose, the yields on government securities rose, and therefore requiring more money to service the debt. But overall, what the government did under fiscal consolidation is that it had to cut some other expenses and then pay obviously the interest component. So overall, the fiscal consolidation has remained on track, and in spite of the fact that actually you have higher debt servicing than what had been budgeted for under the budget of 22-2023.
Thank you, Adam. And just to add to that, yes, Adam has mentioned that the projected debt service numbers have been higher than had been planned for. So, and you all need to appreciate that because we tightened monetary policy to contain inflation, the yields across government securities also adjusted upwards to reflect the tightened monetary policy. And as a result, the cost of borrowing became expensive for government, and that's why government then had to think of alternatives, and hence the plans now to substitute the financing from the domestic market with external financing where the interest rates are quite lower compared to the domestic rates. So that's one angle towards fiscal consolidation in order to reduce the interest rate burden.
Thank you, Deputy Governor. And then in the House, we have Victor from NBS.
Thank you. My question is light. We are aware there is an authority called the Uganda Microfinance Regulatory Authority, but the number of SACCOs is increasing. People are running to SACCOs to save. What could explain this? Thank you.
Thank you. I think I have the Executive Director of Supervision who is well positioned to answer that question. Titi.
Yes, thank you, Deputy Governor. Your allegation that people are running to SACCOs to save, I think what SACCOs are doing is that SACCOs help easily accessible to the average person in terms of growing savings. Most people do not start their savings in commercial banks for the average person. So it is actually a good thing that we're seeing a spike in savings for SACCOs, and gradually it is hoped that as their savings and financial services needs increase, they will then graduate to the financial sector. So it's not a bad thing, it's actually a good thing.
Thank you, the Executive Director Supervision. Any more? We are waiting on YouTube. We have, I don't, oh, okay. Go ahead with your question.
My name is Collins from NTV. To the ED supervision. Recently, you had some of the major global banks developing a code, and these affect banking all over the world. How insulated are the banks here, the ones that you supervise?
Yes, indeed. I wouldn't say they developed a code, but there was a bit of a scare or a bit of concerns about the performance of some of the global banks. Fortunately, for some of the bigger ones, they have subsequently been resolved. We had Credit Suisse taken over by UBS. But if you look very carefully, the issues those banks had are issues that were historical to the way they conduct their specific and particular business models. Now, turning back to Uganda, if you look at the issue, say, for example, with Silicon Valley Bank or First Republic, the issues there were around the concentration risk in terms of their holdings of government securities. In Uganda, fortunately, we have done an assessment. There is no bank that holds more than 25% of its assets in government securities. So even a proposed increase in interest rates would not cause a shock to significantly erode their liquidity or their capital. So from that, in terms of their resilience to interest rate shocks, the banks in Uganda, all without exception, are actually resilient to that. Now, if the issues that happen with the global banks, would that impact the banking sector in Uganda? Not entirely. There was an initial scare, but right now, if you even look at the share prices for some of these banks that were having a bit of a hiccup, to use your words, they've restored back their share prices. There's less concern since the central banks or the regulators in those jurisdictions have come out very strongly to support them. So I think at this point we can comfortably say that we are immune from those shocks at this time.
Thank you. Dr. Twine, you have a follow-up question from Ali Twaha. Kindly give us an update on how many financial institutions have met the new capital requirements under phase 1.
I would say that the majority of the banks have. The provisions in the law are that they have an extra 6 months to put together the capital, and the 6 months will be ending 30th of June. I think perhaps we'll come back to that question after June. Thank you.
Thank you, EDS. If there are no more questions, then thank you very much. You have access to the statement on the BOU website and also on our social media platforms. Thank you so much for joining us today, and have a nice rest of the day.
Thank you. Easter.
Happy Easter, and happy Easter holidays.